Hey everyone, it's Imran back again with another macro options spotlight. Okay, what are we looking at? So, bank walk continues. Despite the cheer in markets around the debt ceiling deal getting passed, it's now gone through the House and the Senate. Last week's data did show that money market funds, that their assets have been increasing and they're at record highs, 5.42 trillion, and they've been rising 6 weeks in a row now. So since the SVB crisis kicked off, we've seen 600 billion of inflows, with both retail and institutional clients fleeing to less risky assets, right, money markets. So now we've got a deposit report, H8 deposit report from the Fed that comes out estimating commercial banks' balance sheets. That's going to be out. It's likely to show that the bank walk is continuing, and where would that money market? Where would those assets be coming from? Likely they're coming from bank deposits continuing to leave, but just not at a staggering pace. And despite that, markets do continue to rise. Stocks have been rallying with tech stocks outperforming, and they're kind of seemingly ignoring it. Although if you look at the bank stocks, they're not really participating in the rally. Now, whether it's showing up in markets yet or not, the reality is that small and medium-sized banks are going to have to shrink their loan books. And this is going to make it harder for businesses to get bank loans or keep the bank loans they have. So this is going to make it more difficult for the Fed to keep hiking rates, because this kind of rise in credit cost for businesses is going to do some of that work for the Fed. Okay. Now, last week, market was pricing in 65% for a 20 probability for a 25 basis point hike in the June FOMC on the 14th. This is now repriced down to 25% after some dovish Fed speakers. We saw weaker data with the likes of ISM manufacturing missing expectations. And we also saw a drop in unit labor costs, relieving price pressures. So the next big data point is obviously today's non-farm payrolls. That's probably going to swing markets a bit as well. But, looking at the drop, that's quite a big drop in a week to see probability of a hike go from 65 to only 25%. Okay, so clearly there's a fair amount of uncertainty still into what the Fed is actually going to do. All right, what about the vol space? If we jump over to our cross-asset vol analysis, what do we see? So obviously stocks have rallied on the debt ceiling, broad-based rally, all indices were higher. Commodities also getting a lift from the dollar being weaker, except for natural gas, which just can't really catch a bid right now. Turned around pretty violently since it did have that brief rally, down another 4%, and that makes it 12% on the week. Uranium had a great day yesterday. You see that sector up 6%. Cameco, the big miner that we obviously track, was up 10% on the day. And we are seeing some signs that the US is looking to approve more reactors, something that we've already seen out of the likes of China over the last year or two. So if the US does get a bit more nuclear friendly, then that whole space could re-rate quite dramatically, right? And we've been talking about that as a long-term theme for quite some time. And then looking at the US data, obviously coming down, reducing the odds of the June hike, that also supported bond markets. So we've seen TLT bounce into month end, but kind of holding on, grinding slightly higher. And then all the sectors were kind of up. We had metals and mining up 2%, actually doing a bit better than tech for once. But ARC was still up 1.5%, breaking above that resistance level we've been looking at. And that may well open the way for another rally in ARC. It is up 7% on the week. It's been doing pretty well. Looking at SKU did get slammed. It's down quite heavily on the week now. Obviously, the debt ceiling deal getting passed through, taking out some of that tail risk. We do think as the SKU and implied vols get smashed, that has helped the market rally through the Vanna effect that we talk about, right? When vols come down, when SKUs come down, that evaporation of put premium leads dealers to need to cover short deltas, and that takes the market higher. And then looking over at carry, we are seeing quite a lot of red in the equity space, right? So as vol gets slammed, it's becoming easier to be owning options because the market is moving around. So even though the VIX is down through 16 to 3-year lows, and we have got a fair amount of dealer gamma up at 4,300 on the S&P, because we are seeing a lot of negative and a lot of negative carry numbers, it means that the gamma is becoming a little bit easier for market makers to hold. And so vol doesn't necessarily need to collapse that much if the market continues to give those gamma traders opportunity to make back their theta bills. Okay, looking elsewhere, nat gas carriers turned positive as well, as it's been an orderly sell-off, as implied vols have popped and the market's just kind of steadily going back down. And then TLT in positive carry as well. Even though we've seen a 4.5 vol point drop in TLT vols, the carry is still positive because the realized is only 10. You look at the other bond, the credit side, 6.5 vol on at the money HYG, and it's realizing 7. So we've got negative carry in HYG, suggesting that vol in HYG is looking better value. And that actually leads us onto our trade idea, because we're looking at HYG in a bit more detail. All right, so looking at the trade, what we're seeing here, recent banking sector troubles, the impact it's having on lending standards. We've been watching the credit market for some stress. Now, clearly, HYG is not the same as the financial credit market, but we do think that it should be impacted to an extent if there's going to be credit issues going forward. Now, looking at this chart, we've zoomed out onto a weekly chart, and we can see that HYG has been coiling. It's been in this triangle formation, and that triangle is getting narrower and narrower to the point where pretty soon we're going to have to break out either to the upside or the downside, and that may lead to an acceleration in price, as it often does from a technical perspective. This zooming out into the weekly chart also shows us that when this thing breaks, when you get major market downturns, HYG can have some serious movement in a short space of time. Okay, so let's be clear. Vol's at 6.5 vol in the front right now. So when this thing breaks, we know it can move. So if you are fancying a bit of a risk asset meltdown or even a melt up in the next few months, if HYG breaks out of this formation, it could participate and have a reasonable move. Okay, so as we said, vol's been coming down, and we think picking up some long volatility in HYG ahead of this potential break of this triangle does make sense. Now, we are fundamentally more bearish. That's been pretty obvious from my commentary over the last few weeks. Over the medium term, we're more bearish, but we do recognize that the risk of a squeeze in risk assets, especially with the S&P popping above 4,200, that may well drag HYG higher. So in terms of the strategy compass, we look at HYG. It's basically screening as a bit of a buy, straddles or strangles. Spot's a bit more neutral, middle of the range. Vol's near the lows. And we look at the carry, it's actually small negative, right? So it's saying owning options isn't a bad idea in HYG, given how low vol's got, and given the fact that realized is actually holding up okay now. So there's very little volatility risk premium being priced into the implied vol of HYG. Okay, so we think owning makes sense, owning some vol. Now, skew has been coming down quite a bit as well. It's like 1.5 vols. I mean, that's traded as high as 4 vols. So it's come down quite a lot. And because of our views around timing of the move, while we think in the near term, in the short term, there might be melt up risk, more medium term, we are bearish, right? So that leads me to not just do a straightforward strangle. I actually like the idea of doing what we call a calendar strangle. All right, that's the trade idea for today. Have yourselves a great weekend. I'll catch you all next week. Thanks.